1 year after the European Union launched an anti-subsidy investigation into Chinese electric vehicles in October 2023, the hammer of higher tariffs has finally come down. On Friday, October 4, 2024, EU member states voted on whether to impose hefty tariffs on electric vehicles exported from China to the EU. Ultimately, the 27 EU member states voted 10 in favor, 5 against, and 12 abstentions, supporting tariffs of up to 45% on Chinese electric vehicles for 5 years. The European Commission subsequently stated, despite differences among member states on this issue, the European Commission has received the necessary support to implement the tariff measures. An EU diplomat revealed that the Commission will publish the legal text of the tariffs by October 30, 2024, and these tariffs will take effect on October 31st. While there is still almost a month for China and the EU to negotiate a resolution, the European Commission now faces no procedural obstacles. To overturn this tariff proposal, at least 15 member states representing 65% of the EU population would need to vote against it, which currently seems highly unlikely. Europe's antagonistic stance toward China's electric vehicle industry is rooted in a long-standing anxiety over the rise of Chinese manufacturing. The tariff measures, ostensibly designed to protect local industries, actually reveal Europe's helplessness in the face of its heavy dependence on Chinese technology and supply chains. The fundamental reason behind Europe's struggles in the electric vehicle sector lies in its own lack of innovation and fragmented supply chains, rather than competition from Chinese companies. Trying to slow down Chinese firms by imposing tariffs is a self-deceptive way to cover up internal issues. 2 months after Europe imposed tariffs on Chinese electric vehicles, the results have been the opposite of what was expected. According to Bloomberg, car sales in Europe have declined, particularly for electric vehicles in Germany, driven by the weak European economy and high electric vehicle prices. Consumers simply aren't buying. Against this backdrop, Volkswagen has had to prepare to close its Audi plant near Brussels, Germany, for the first time in 87 years. Ironically, this news led to a 1.2% increase in Volkswagen's stock price. Moreover, Volkswagen is planning further cost-cutting measures, which may involve closing additional plants in the future. Western industrial policy lacks long-term vision and consistency, being more motivated by short-term political interests rather than genuine economic optimization. In contrast, China has demonstrated remarkable strategic consistency and patience in developing its new energy sector. Neither the US-China trade war nor European tariffs will change the fact that Chinese companies are gradually taking a dominant position in the new energy market. According to market research, by the end of 2023, Tesla held a 19.9% share of the global electric vehicle market, followed closely by Chinese companies. BYD held 17%, GAC Aion 5.2%, and SAIC GM Wuling 4.9%, while Germany's Volkswagen accounted for only 4.6%. Although Tesla still led globally in 2023, based on production forecasts for the first and second quarters of 2024, BYD is expected to surpass Tesla by the end of the year, becoming the largest electric vehicle producer worldwide. BYD's performance in the hybrid sector is even more impressive, with a global market share of 33.8% in 2023, while China's Li Auto captured 9.6%, giving the two companies a combined 44% share of the global market. More importantly, Chinese electric vehicle companies are not only leaders in sales, but also invest heavily in research and development. Tesla's gross profit margin stands at 15.8%, while Li Auto's is 20.5%, and BYD's is an impressive 24.5%. This means Chinese automakers have more funds available for R&D, enabling them to maintain a technological edge. According to CNBC, BYD invested $1.47 billion in R&D in the first quarter of 2024, far exceeding Tesla's $1.15 billion. Given these figures are in US dollars, the real gap might be even larger. Therefore, in both the short and long term, China's advantage in electric vehicles remains unshakable. Chinese companies are not only ahead in R&D investment but also outperform their Western counterparts in production efficiency and supply chain management. Companies like BYD and CATL, with their vertically integrated supply chains, can respond swiftly to market demand, adjusting production and logistics accordingly. This comprehensive control allows Chinese new energy companies to gain an edge in both cost and quality, forcing Western nations into reluctant dependence on China. By 2023, BYD's production lines had reached a leading level of automation globally, ensuring quality while significantly reducing production costs, something Western countries will struggle to match in the short term. In the battery sector, China's lead is even more pronounced. CATL holds a 37% share of the global electric vehicle battery market, and BYD 16%, with the combined market share of these two companies exceeding 50%. Chinese firms in total control more than 75% of the battery market. Analysts at Morgan Stanley predict that by 2030, CATL alone will account for 35% of the battery sales in the European market. Despite Europe's attempt to protect its domestic industry through tariffs, it still relies heavily on Chinese batteries. More concerning is Europe's insufficient technological foundation in the new energy field, as it lags behind China in fundamental research. Media outlets often hype up supposed breakthroughs by Japanese and Korean companies in the battery sector, but these countries still trail China significantly in basic research and supply chain capabilities. According to an Australian think tank, 20% of electric vehicle battery research papers globally were published by Chinese researchers, and China accounted for 65.4% of high-impact papers in this field, far surpassing the US at 11.9%. This not only reflects the volume of academic output but also signifies control over future technologies. China's number of battery-related patents grew from 31 a decade ago to 660 today, 1.5 times that of Germany, which ranks second. This growth in patents demonstrates China's massive lead in the battery sector. Moreover, Western countries' lagging technological innovation is also evident in government support policies and market responsiveness. Unlike the comprehensive support provided by the Chinese government for the new energy sector, European policies are often delayed and inconsistent. For example, when facing challenges with local industries, the German government's subsidies and protective measures pale in comparison to China's strategic investments and comprehensive support, leading to a gradual decline of German companies in the international market. China's control over the electric vehicle industry extends beyond manufacturing capabilities to encompass key materials. China mines 60% of the world's rare earths, holds nearly half of the world's cobalt reserves, and a quarter of its lithium reserves. In refining, China refined 95% of the world's manganese, 70% of its cobalt and graphite, 67% of its lithium, and 60% of its nickel in 2023. This means that if China chose to halt exports, the rest of the world would be incapable of producing batteries. By controlling these resources, Chinese companies can innovate and conduct R&D more quickly and conveniently. Thus, the first to achieve breakthroughs and commercialization in solid-state battery technology will undoubtedly be a Chinese company. This control over key resources is not only the core competitive advantage of China's new energy industry, but also a major reason for Western dependence on China's supply chains. The chief economist for Asia-Pacific at Natixis stated that China's control over key chemical materials represents ultimate control over the entire industry, and it is clear that China began pursuing this goal years ago, a true long-term strategy. Western sanctions and tariffs, by contrast, are merely short-sighted acts of self-preservation. Companies that were supposed to benefit from these tariffs, such as Tesla, have also seen significant sales declines in Europe. Tesla's sales fell by 12% from January to July this year. It is evident that imposing tariffs has not protected the European electric vehicle industry but rather accelerated its own decline. These figures indicate that the problem lies not in China but in Europe's internal divisions and short-sighted policies. Europe's so-called protectionist policies are merely attempts to delay industrial decline through administrative means. In today's globalized economy, such behavior is increasingly ineffective. Europe's electric vehicle industry lacks innovation and supply chain control, whereas China's rise is built on solid technological foundations and a complete supply chain. Western efforts to curb China through tariffs and sanctions will only backfire, accelerating the erosion of their own industrial base. China's success is no accident but the result of steady advancement in infrastructure, R&D investment, and international cooperation over many years. Western countries need to reflect on how to improve their own industrial competitiveness rather than persistently erecting barriers to block China's progress. Only by genuinely enhancing their own technology and supply chain capabilities can the West find its place in the new energy revolution.